All right, traders. So welcome to the first of many in a series, Why Traders Fail. So yes, we're going to do a long series on why traders fail. I'm going to try to keep each episode fairly short and cover all the different pieces of the puzzle on why you may be having a difficult time in the market. This is good for pro traders as well as brand new traders who have never traded before. I'm sure there'll be something in here for everybody to help us all improve our game. So definitely want to, if you leave comments below, let me know what you're thinking, what you think about the stuff that I'm talking about. You know, you agree, you disagree, stuff that helps you, stuff that, that caused you to fail in the past that others can learn from, all that stuff. I want this to be an educational piece for everybody to kind of share and learn from. All those who are just haters, who have nothing constructive to say, they just want to bash people and do all that stuff. You're probably doing that because you're a failing trader and you want everybody else to suffer as well. But if you want to be constructive and positive and help the community, then go ahead and leave a comment below. If you just want to hate on others that are making comments, please don't do that. I will delete your comments. So I want this to be a positive forum where people can share information and learn from one another, not sit here and bash one another. So let's get right into it. Why traders fail. And if you can hit that like button, that would help me out a lot. And if you're not already subscribed, subscribe and hit that bell icon so you can be notified of the next episode. So episode 1, let's get into it. All right, before we get started, I want to say that I'm not telling you what to do. Do not take anything I say here as telling you what to do. This is not financial advice. Trading is extremely risky. You can and probably will lose all of your money. It's pure speculation, and this is for entertainment and education, not telling you financial advice or what to do with your money. All I could tell you is from my experience what I do, and then you do with that whatever you want to do with it. All right, let's get into it. So the first reason, well, there's many reasons, and I say the first reason, but I don't think it's necessarily in order. But one of the main reasons why traders fail is I don't think they understand what the game is. So here we're going to cover, in this episode, we're going to cover trading catchphrases and why they're probably making you fail, or at least hindering your game if you're still successful. Another big thing that's definitely probably affecting you, if you haven't already discovered this and did something about it, is trading you and not them. Big deal. Trade you and not them. We'll get into the details of that. And like I said, the number one reason probably a lot of traders fail is they don't even understand the game they're playing. So if you don't know what the game is, how are you going to play and win? And yes, trading in the stock market is a game, like it or not. It's a game. You're going to have winners and you're going to have losers. Which one are you going to be? All right, so what is the game? So first, let's talk about some of the tools that are needed to play the game. So you have to have the required tools to play the game. And if you don't have these, you can't play and win, right? Like if you're going to go play golf, you got to have a golf club and a golf ball. If you don't have that, you're going to go out there, you're just going to stand there and look like an idiot. And at the end of the day, you're going to have like nothing. So you got to have the right tools. So the main tool that you need to have to play this game is your trading plan. So without a successful trading plan, no can do, right? Your trading plan is your map. It's the map that's going to help you get to where you want to go. And this trading plan has to fit your vehicle. So if you go and buy somebody's trading plan that's like an aviation map and you're driving, you're going to go right off a cliff, right? It's not going to work out very good for you. So you have to have the right trading plan that fits your vehicle. That's the first tool that you need if you think you're going to win this game. All right. The next piece that you absolutely have to have if you think you're going to win this game is a trading log, some kind of log. This can be a notepad that you write on. It can be a nice Excel doc. It could be a program. It could be all kinds of stuff. But if you don't have a log to track what you're doing so that you can see your progress, it's like your compass. It's like your thing it's like your bumpers at the bowling alley to help you get a strike. It's the thing that's going to kind of keep you along your plan and keep you going. It's your flashlight in the night, all that stuff. You need to have a solid log that you can log your trades, and then you have to use that log. You can't just have a flashlight and never turn it on. You're not going to see in the dark just because you're holding it, right? You need to turn it on. You need to use it. You need to be effective with it so that you can guide yourself properly. So trading log and your trading plan. If you have those two tools, you have everything you need that you can start and get moving so you can win this game. If you don't, hit pause, go get those things, and then get ready to play the game. All right, next. So The trader's mission. I know you're like, what is the game? What is the game? Exactly. You're learning what the game is right now. What is the trader's mission? What is it you have to do? What, like, when you're playing golf, you hit the ball and it's got to go in a little hole that's far away, right? So like that's miniature golf, same thing. Bowling, you throw this ball down there and you got to knock down those pins. Like, what is your mission when you're trading? So your mission is this one thing. That one thing is to follow your trading plan. That's it. To follow your trading plan. Once you've gotten your trading plan, you have a solid trading plan. It's good. It works. It's vetted. It's proven. All that stuff and all the pieces that go into a trading plan are there. Look at my trading plan video, how to create a successful trading plan if you don't know what's supposed to be in there. And when you have your successful trading plan, your only mission is to follow your trading plan. All right. So now, what is the market's job? What is the market's job? So that's your job. Now your opponent is going to be the market. The market could be whatever you want it to be in your world. It could be a computer. It could be somebody else on the other side of the table. Whatever you want to call that. What is the market's job? Let's get into that. Okay, so the market's job is to make you lose. That's the market's job. So how does it do that? So the market's job to make you lose is to show you all these different pretty colors and lights and all kinds of stuff that you can put on here and blinking and sounds and whatever's going on your trading platform, all that stuff, all that noise, if you will. It's designed to use all of these tools, volume, whatever it is you might be looking at. Its job is to use these things to deceive you and to trick you and play a mental game and just go in there and psychologically cancel out everything that you think you're doing with your trading plan. Its job is to knock you off your plan. And it does that by putting all this stuff up here and giving you hope and making you wish and making you want and playing on all your different things like greed and all your different emotions of, FOMO and greed and whatnot. So it's there to exploit every single thing that's in your brain to knock you off your plan and make you lose. How do you win? How do you win? So how do you win with that, right? When you have all that working against you. And when it works against you, it's like this too. Look, watch. So right here. So we have this slide right here, right? So everything's 2020. It's always easy to look back and say, oh, well, look, it's clearly in a channel and isn't a down thing and all this stuff. And I would have did this and I would have did that and blah, 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 right? So you say all that stuff and you're like, I woulda, coulda, all that stuff you're saying. But a lot of times you don't get to see all that stuff. So maybe you're here and then you see this and then you have this big slide. And now in your mind, you're going to say, I want this to go up. I want it to go up. I want to be in a long trade because I like this company and I want it going up. 1, 2, 3, 4, 5, 6 red candles. So you're like, oh, I can't have that many more red candles. It's got to go back up soon. So you decide to buy in and you buy in right here and you're like, oh, look, I almost picked the bottom and it's going back up. It's going back up and you get all excited. And then maybe you even add to your position right here because now it's going all the way back up to the top to retest the high of day and you're going to make all this money. And then it does that and you lose all your money. But you wanted it to go up, so you justified a reason why it would go up, right? Maybe it was all these candles. Maybe it was came down through a support area, a resistance area, whatever it is. Whatever excuse you want to give it, right? You can make your excuses. Maybe it's the candle that formed right here, and then it had a green candle after. It must mean it. So you do all of that. Or you're the trader who says, I want it to go down. So you're like, oh, all these candles going down. And then you have this green candle right here. And you're like, oh, I'm going to buy that green candle because it can't have all these red candles. So I'm going to get that and reduce my risk. And then it starts going up and you're like, oh, no, I'm going to sell because I don't want to lose all my money. And then you get out and you take a loss and then it goes back down. Like the market's job is to manipulate you into taking all of your money. And the hard part is when you're looking at a chart, you can kind of justify all kinds of different things that you want to happen. And sometimes things like this, here's a nice little flag pattern, it breaks down, I'm going to get in, and it works. And then other times it doesn't. So it'll sometimes give you little nuggets like bait, and then you'll trade it every time after that. And you'll, at the end of the year, lose all your money. And you're like, what happened? It worked in the beginning. I don't know what happened. So the market's job is to totally manipulate you into taking all your money by knocking you off your plan. So your job to be able to be successful The market's mission, we just told you. Your mission, to follow your plan. That's it. How do you win? You follow the plan. How does the market win? It knocks you off your plan. It's that simple. That is the game, everybody. The market's job is to knock you off your plan. If it does that, it wins. And it does that through psychological means, playing on your emotions, all that stuff. Your job, sorry, I've got trading going on in the background here. Your job is to follow the plan. If you can have a solid, successful plan and follow it, you can win in the market. That simple. That's what it breaks down to. All right, so moving on. All right, so now trading catchphrases. Believe it or not, I think this could be making you lose money. So let's look at the popular trading catchphrases, and then we'll look at some that you probably should pay attention to. Okay, so trading catchphrases. This is probably making you lose money, actually. The most popular trading catchphrases are probably costing you money. So let's look at them and see why. Like, why are they? Cut your losers short and let your winners run. What does that even mean? Like, what is that? So cut your losers short. So, oh man, I guess we're going to have to go look at a chart to really show you this one. Cut your losers short and let your winners run. What? All right, so let's look at Starbucks. So Starbucks is a winner we just had. I alerted it out to my membership, and we were able to take advantage of this nice winner. But let's say that you bought it right here. It's on its way up. It gaps up right here. And then you bought it, right? You're like, oh, it's going up. I'm in. And then it's coming back down. You're like, oh, no. And it breaks this level. And you're like, oh, I got to cut my losers short. So I'm going to get out. And then it rallies all the way up. And you would have made a whole bunch of money, right? But you cut your losers short. Good job for you. Lost all your money. Cut your losers short. What does that mean? So, or let your winners run. Let's look at that real quick. All right. So let's let your winners run. So you jump in somewhere right around here, maybe, or right here, and you're like, oh, I picked the bottom. Look at it go. It's going. And then it gaps up, and you're like, yeah. And I'm going to let my winner run, right? Because that's what you're supposed to do. That's what the catchphrase is. Cut your losers short, let your winners run. And then bam, gap, and you just blew up your whole account, right? Boom, just like that overnight. See you later. Because what did you do? You let your winner run. So what does that mean? So stupid. So here's what you need to do. So forget about those stupid catchphrases of cut your losers short, let your winners run. What you need to do is put your stop in the right spot and get your target in the right spot. And that's what you trade. You trade the correct stop and the correct target. Forget about letting stuff run in losers and this and that. Like if you have a strategy and a plan that says this is where I need to get in, this is where I need to get out, that's what you do. If you have a strategy that allows you to squeeze more out, then that's what you do. As long as there's a statistical proven probability of success, or a proven statistical probability of success for what you're going to do, and it's part of your plan, and it fits all your lifestyle goals and all that stuff that goes with your plan, then that's the right thing to do. Forget about cutting your losers short. I don't want to cut my losers short. I want to cut them when I'm supposed to cut them. And according to my algorithm right here on this trade, I would have had to cut it right there. And according to my algorithm on this trade, I needed to get this target. And then if I could squeeze more out, great. And then I'll have other trades that show up. And I showed you how the scaling ladder goes, right? So look at all this I missed out on. Like, oh no, look at all this trade I missed out on. But I don't care because I just hit it again right here and made some money. So the reason why I don't care is because my scaling ladder showed me that if I take this many trades, which I know I can do in a year, I'm making this much money, I'm good. I'm happy with $700,000, $800,000, $1 million, whatever it is, $100,000 even, whatever. I'm happy with that. So I don't care if I miss out stuff in here. Let somebody else have that. So forget about cut your losers short and let your winners run. Stupid. Trade what you're supposed to trade. Take what the market gives you. All right, so next, you must have a 2-to-1 reward ratio or better. So I hear this all the time. So let's go back to the chart. Because a lot of you are getting fooled on this. Okay, so 2-to-1 reward ratio, right? So this is what happens. So, man, it's so frustrating to me. So traders will do this. They'll buy right here for whatever reason. They'll have the thing, it goes up, it's making a new high, it pulls back, they decided to buy in the pull back, maybe they put their order in overnight, whatever it is, They get in right there. And then they're like, all right, so now where's my stop going to be? And they're like, all right, well, if it breaks this support level here, I should probably get out because it's probably going to go down. All right, cool. Sounds good, right? So you put your stop right there. And then you draw up your lines so you can have your 2-to-1 risk reward. This is what a lot of, oh man. So they draw it up and they're like, okay, I have to have a 2-to-1. So I'm going to put my target right here. So this is my target. Let me put a line on it, right? Or put an arrow on it. So this is my target, right? And this is my stop. So I got my 2-to-1. All right, cool. So I'm not going to get out no matter what until I get my 2-to-1 risk reward ratio. So they stay in. But now look, this is a new highs right now. So like there's no, like this is like the sky's above. You can't go back in the chart and say it's going to get to this area and it might have resistance and all that stuff. Like there's sky's the limit right now. How high is it going to go? You don't know. It could go way past that. Might not even get there. But you put your 2-to-1 because that's what you're supposed to do. And then that's what happens. Gaps down, right? Gaps down. You were in here. If you would have got out right here, right in this resistance zone, right? You just get out right before resistance. You put money in your pocket. You're good to go. Yes, this was your risk way down here. Your risk reward is way off. But if that's what you did, you'd be making money. But you followed just a random, hey, I should have a 2-to-1, so I'm going to do that. And then it's game over, right? You lost all your money. So, man. So for me, it's not about having a 2-to-1 risk reward ratio. You could have like, it could be worse. Like you could have like for every $10 that you win, you're losing, every $10 you win, you're losing $13. But if you win 95 out of 100 trades or 85 even out of 100 trades, at the end of the year, you're still making money. Like you're still winning. So you must have a 2-to-1 risk reward ratio. What is that based on? So you need to ask yourself that. When next time someone tells you that or you hear that, what is that based on? Is that based on a statistical proven probability of success that every time I take a trade and I wait for a 2-to-1, I'm going to have an 80% win rate or whatever that win rate is? And is it good enough for you? Or does it just sound good? And then go and do a back test and see what that really means. 2-to-1 risk reward ratio, not as easy to come by as you think. Definitely possible. I mean, I have it many times over, not as part of my strategy, but I do get those. So yeah, anyway, 2-to-1. Don't let this make you lose money. You could have a 1-to-1 risk reward ratio and make plenty of money. You could have a 3-to-1. You could have a 1/2-to-1. What matters is at the end of the year with your trading plan that it fits you and you're making money. So don't think that you have to have this. If you can have it, fantastic. But you don't have to have this. All right. So the trend is your friend. The trend is your friend. The trend is not your friend. So here we are. So here, if you saw this, the trend is going up. Trend's going up, right? And then you bought right here. Game over for you. But I was buying with the trend. The trend was going up. Why did I lose my money? Who cares what the trend is? The trend could be going down and you can buy long. The trend could be going up and you can short it. Like, it doesn't matter what the trend is. What matters is in your trading plan with your strategy, are you making money? So don't think that you have to trade with the trend. You can counter trend trade. That's a popular thing. A lot of people counter trend trade. Even like my scalping algo is a counter trend trade type deal. There'll be a big giant green candle and I'll short that thing and I'll make tons of money doing that. So you don't have to trade with the trend. It's not your friend. It's just a thing. The trend is just a thing. It's just part of that manipulation of the market to try to get you off your plan. Forget about it. Don't worry about trends. Just worry about what it takes for your plan to work. Now, if your plan says I can only trade in an uptrend, then great. Then you're looking at a trend and you're only trading in an uptrend. It doesn't mean the trend is your friend. It's a thing. It's just a thing. You can only trade a downtrend. Then you just trade a downtrend. It's not your friend. It's going to bite you. It's just a thing. All right. So don't catch a falling knife. Never leave money on the table. Like what? So buy low, sell high. Come on. Seriously? Like you're going to pick the bottom and the top all the time. Like that's possible. Like anybody who tells you that if you want to be a successful trader, you have to buy low and sell high, run from them because you're not picking bottoms and tops. Most successful traders they pick a thing and they get a piece of that thing. So, the stock goes up. Some traders buy high and sell higher. Some traders buy low and sell lower. Some traders buy bounces and all this other little stuff that, most of my strategy with my algorithm is, maybe it did get to the bottom and then it starts to turn around, and then I take a piece of that turnaround, and then maybe it keeps on going back down. Like, I don't care what happens. I got my piece. So most traders who are successful, they're not buying low and selling high. Maybe that happens sometimes. They get lucky, but they're buying a piece of something. So whatever that is in their trading plan. So forget about it. If someone tells you buy low, sell high, run from them. They're just regurgitating catchphrases that are designed to manipulate you out of your money. So never average down. Never average down. What does that mean? Let's go back to the chart. That's another one. It doesn't make any sense. All right. So now we're on a chart. Never average down. Okay. All right. I'll play along for a little bit. Okay. So now let's say never average down. Let's say you went and let's put a line on the chart here. Again, it's all about trading your plan. So let's say you decided to buy long right here. You're seeing some support building. Let's zoom in here. You're seeing some support building right here, and you decide to get in long. But actually, let's zoom out real quick, because you think its support is going to hold. But you know that if it doesn't hold, let's say you decide you're looking at it as, maybe this is my stop down here. So they came up, it came back down, it found some support, it gapped up, and you decide that that's where you're going to put your stop, right? So now you're in here and it starts coming down. And people are like, no, don't average down. What are you doing? You just have to let it ride. You can only add to your position when it's above your entry. Like, what? So if I'm coming down close to risk and I want to add to my position to improve my cost basis so that when it does rally back up, like right here, let's say I added around here, it rallies back up, I can pull off the position I added if I want to. Now if it becomes a loser, it's a tiny loser, or I can hold on to it, and now when it breaks above, it becomes a much bigger winner. Don't add to your position if it's going, never average down. Like, averaging down is an excellent tool to be able to be more profitable. Now, only place that it makes sense, and I wouldn't say it's averaging down, is I don't add to a losing trade, right? Averaging down is an awesome way to make money. Forget anybody who says don't average down, ask them to clarify that. Because if they really mean don't average down, they're telling you to get rid of a tool that you can use in your strategy to make you a ton of money and beat them in the market. Now, what they might be really saying is don't add to a losing trade. So what is that? So if we said this is our stop, if it breaks this, it's over for this ticker. Like, I might short this if it breaks this, it's over. Not saying that I am based on a technical here. This is an example. If you're telling yourself that breaking this is a losing trade and you can short it and maybe make your money back, I call that a speed bump, and it breaks this and then you add to your position, now you're adding to a losing trade. You just said before you started trading that if it breaks this level, it's game over. It's going down. This thing's in the crapper. It's history. Bye-bye. See you later. So why would you add to your position? So that's adding to a losing trade. So that is true. You do not want to add to a losing trade. But to average down and have a better cost basis, get your cost basis closer to risk and all that good stuff, why not? So anyway, another catchphrase in there. Never average down. Why would you say that? Okay, this is the last one that I'm going to go over because there's so many of them. And the point of this is I want you to think about next time you hear a catchphrase, think about it. Don't just be a sheep and listen to it and follow it. Don't be like, oh yeah, they said buy low, sell high. Yeah, it makes sense to me. Don't catch a falling knife. Yeah, all this stuff, right? Or manage your risk and don't lose more than you want to. Okay, well, what does that mean? What does that really mean? All right, let's go back to the chart. What does that mean? So this is how I believe a lot of traders interpret it, because this is what I hear from other traders is this. So what they'll do is they'll say, you know what? I'm going to go ahead and buy. Let's zoom in here. I'm going to buy this. Let me erase these real quick so we can, I'll just move it. I'm going to buy this right here. This is where I'm going to buy it. Right on this green candle, it's coming back up. I think it's going to break above. Whatever the reason is, you're going to buy it right there. And let's see. Let's just move this up so we can see what the number is. 130.95. So we're going to take this just to make this easy math. 133.95. So $3. So they're gonna buy it right. Let's say they buy it right here on this candle here. All right. For whatever reason, that's where they're buying it. It's on its way up. They think it's so now they don't want to lose more than $300. So they buy 100 shares and they're like, the saying is, you manage your risk. You have to manage it. Don't lose more than you want to. So I bought 100 shares. Why? Because I could afford 100 shares. I maxed out my account and bought 100 shares. But now, man, I don't want to lose more than $300. So I better put my stop right here, or I'm going to lose more than $300. I'm doing what they said. I'm managing my risk. I'm not going to lose more than I want to. I'm following the rules. So right there, is there a proven statistical probability of success with that? Probably not, because then this happens and you lose all your money and then it goes up without you. Traders, how many times have you felt like the market's like, oh, it stopped me out and went without me? Oh, the market's rigged. It hit my stop and went without me. Maybe your stop's in the wrong position. Why did you put it there? Because you didn't want to lose more than $300? Like, what is that? Your stops need to go in the right spot. I don't trade with hard stops because then the market's going to know where my stop is and it's going to come and get me. No, the market is not coming to get you. Your stop's in the wrong spot. There's a game being played, traders, and if you have a solid plan, then you know how to beat the game. And if you know how to beat the game and you don't trade the plan, then you don't beat the game. You lose. So if that's happening to you, you're putting your stop in the wrong place. Why did you put it there? Did you put it there because you didn't want to lose more than $300? Did you put it there because you had confirmation bias and that's where you thought it's going to go back up or it's going to go down from here because I say it is? Is there technical analysis on the 5-minute chart that conflicts with the 30, that conflicts with the 2-minute, that conflicts with the 1 hour, that conflicts with the daily? Like all those technical analysis things that can totally mess you up. Like you have to have a solid plan. And if you don't have a solid plan, none of this other stuff matters. All right, so let's talk about catchphrases that actually work. These are ones you can actually put on your wall. They make sense and they will work for you. So I'm not going to spend a ton of time on them. I'm just going to go zip through them because they should be very easy. So the first one, what works is what's right. How simple is that? If it works, do it. Who cares if someone else thinks you're an idiot and calls you out on YouTube and Facebook and everywhere else and tells you how stupid you are? If it works for you, it works for you. And what works for you might not work for me. Like, I don't want to have a plan that's 55% success rate. Like, that doesn't work for me. Psychologically, that would be devastating to me. But to you, that might make you a millionaire. So it doesn't matter. What works is what's right. So, and if it's legal and it works, it's what's right. All right. And it's moral. All right, cool. So trade your lifestyle, personality, and goals. Traders, if you're not trading your lifestyle, personality, and goals, I don't know how you can win. Like, trading is not going to be a fun thing for you. For example, if you're trading because you want to spend more time with your family, boating, traveling, doing other things, and you just want money to kind of be there, and that's why you're trading, but then you trade on a 1-minute candle or a 5-minute candle, the market's going to suck up most of your time. Whereas if you trade on a 30-minute, a 1 hour, 4 hour, daily, maybe, like on a 4-hour candle, you check the market every 4 hours if that's what you're trading off of. Now you have all this time. You're looking at the market 3 times a day for 5 minutes, right? So you work 15 minutes a day and you have all this time to do whatever you want. Or you're trading on the daily candles and you just have, so there's all these other things. You have to make sure the market fits your lifestyle, personality, and goals. And if it fits you, not me, don't trade me because you know what I'm doing. It needs to fit you. And we're going to talk about that more in a minute. So next one, only trade with a proven probability of success that fits your trading plan. And this should be a statistical one. You should be able to go back, look at it. You should be able to test it. You should have data in front of you that says this gives me an 80% win rate or whatever it is that's acceptable to you. And it needs to fit your trading plan, which is part of your lifestyle, personality, and goals. Now, knowing that, very next day, everything could be wrong, right? Everything you've proven you thought was right, the whole market changes and it doesn't work anymore. It fails. That happens, and it can happen. It will happen. You have to be able to adapt. And by having your trade log and monitoring and doing all the stuff you need to do as a trader, you can adapt. All right. So create, follow, and maintain a successful trading plan. Can't dispute that, right? Plan your trades and trade your plan. If you don't plan your trade and trade your plan, you're casino trading. You might as well just pick any ticker and just throw all your money on red, right? Or green or blue, whatever it is, roulette. So trade your plan and plan your trade, trade your plan. No trade log, no long-term success. You cannot monitor what's happening without a trade log. Like, I can't even tell you how valuable it is. If you don't use one, you don't even realize what you're missing out on. Those traders who do use a trade log fully understand what I'm talking about. It's the only way you can monitor what's happening and make adjustments to stay ahead of the game. Bad things could be coming for you, and your trade log will help you see that coming. If you don't have it, by the time you realize it, you're just going to wake up and be like, what happened? Like, it's game over for me. What happened? But traders who use a log are able to sit there, reflect, and assess and manage what's about to take place. They can see it coming. And then the following year, they can also review their trade plan. And when they're making their new plan based on their trade log, they could then enhance that trade plan and be even more successful the following year. So a trade log is really important. I don't think you can have long-term success without it. Trade you and don't trade them. We're going to get more into that in a minute. Let that sink in. You are always going to leave money on the table, or you're going to give some back. So those who are telling you buy low, sell high, forget about it. You're always going to leave money on the table, or you're going to give it back. You just have to choose what it is that you want to do. And literally, like, it's not there's not one that's right or wrong. Like, if you choose to give money back every time you trade, fine. If that works for you and that's part of your plan, back to number one. What works is what's right. If that giving money back every trade works for you, then great. Go do it. Make a bunch of money. Or if you want to leave money on the table like I do, that's what works for me. All right. So take what the market gives you. Don't be greedy. Don't have FOMO. This is your plan. This is what the market wants to give you. And sometimes the market gives you a bill. You know what? Hey, I got to pay that bill today. I'll pay my $100. I'm not going to try to get my money back. Today was my day to pay. Right? If I'm getting my money back, it's part of the plan. I'm just doing my day. I'm not going out and trying to force a trade just to get my money back. So take what the market gives you. You're either going to pay the bill or you're going to get some money. All right. I don't trade for money. I trade to win, and money is a side effect. Get it? I don't trade for money. I trade to win, and money is a side effect. When you trade for money, you allow everything else bad to come in. You allow the market in to hack your brain and take all your money, because that's when you get greedy. That's when FOMO comes in. That's when you're looking at your thing and you're like, oh, $99. I want to even, 100, or, $495 today. My record's 500. I want to just another $6. And then you're trading for money at that point. You're not trading to win anymore. And then the market rolls over and you give it all away. So when you trade to win, money's a side effect, because if you have a solid trading plan, trading to win means you're following your plan, you're following the rules, you're just doing what you're supposed to do like a robot. And at the end of the day, you're winning. Even if you're losing money that day, you're still winning. And at the end of the year, if you're winning because you have a solid plan, you can make money. Okay, so trading you, not them. So really, really, really critical, traders. So first you have to understand who you are. So, is a 1 minute candle too fast for you? Is a 15-minute candle too slow for you? Is swing trading take too long to put money in your pocket? Like, there's so many little things I could talk to you for hours about. In my Creating a Trading Plan, there's a little more information in there on that. But you need to understand who you are and trade you and not them. So when people create a strategy and a trading plan that works for them, they create it for them. They create it for their strengths and they create it for their weaknesses. So if their strength is your weakness and you try to trade their plan, you're going to fail, right? If they create a map, the trading plan is their map. Their strategy is part of their map. If they create it for aviation and you're driving a car, you're going to go off the cliff. So you need to understand who you are, your lifestyle, personality, and goals. And then you need a plan and a strategy that fits you, your strengths, your weaknesses, your vehicle, your financial situation, all that stuff. Another quick example, like if I show you a trading plan where, I start with scaling of $20 a trade, in and out, in and out, in and out. And I'm doing that with Thinkorswim, PDT rule, no commissions, no big deal. I can do that. But now you're with an offshore broker that charges you $10 each trade you make. And now you're doing the same thing I'm doing. You're going to lose all your money because of commissions. That wasn't factored into my plan. It should be factored into yours, but you just copied me. So you need to trade you, not them. What works for them may not work for you. So if you're a new trader, my advice to you is to go and understand who you are, your personality, all that, your lifestyle and your goals. A good way to do that is to get in a sim and just monkey around and start to see how you feel about different things. Then when you start looking at other traders, if you're looking for someone to provide you a strategy and a plan, then you have to figure out, what is it that they're teaching? What is it they're doing? And does that fit you? Like for some people, they want to play the momentum game because they like that excitement, the speed, all that stuff. Others want to play the swing trading game because they prefer to be slow, or others don't want to spend time in the market. So, the reason why they're doing this is to have more freedom. So they're going to want to trade on a 1 hour, 4 hour candles that closes on the candle. They don't have to look at what happens in between. Like my strategy is on the close of candles. So every 4 hours I could check the market. I don't have to sit here all day. I can trade for 15 minutes a day and be good. The other thing is, like, for me, I trade with an algorithm because I want the computer to tell me what to do. I don't want to have to think about it. I don't want to have to use confirmation bias and all this subjective viewpoints. I don't want any of that. I just want the computer to say, hey, you should look at this. Hey, get in here and get out here. And I just want to push buttons. So I trade on an algorithm. That's what I sell over my website. Some people hate that because that takes the fun out of the game for them. That takes the excitement out. They want that, that higher uncertainty. They want to have to battle the confirmation bias and subjective viewpoints. They like that. So, and that works great for them. So you need to trade you and not them. So for any of you that want to click on the link below and jump over to my website and you're interested in my strategies and stuff like that, please, my classes are free. So you can learn everything I do and see if it fits you before you make any kind of like purchase of an algorithm. Because if it doesn't fit you, you shouldn't do it. Don't try to force it just because you see me making money or you see Ross or you see all these other people making money. Don't try to jump into their strategies and force it. There's so many different traders out there that are teaching their strategies. You can find one that fits you. And if you can't, you might find pieces of them. You might like, hey, I like the idea of the 2020 day trader algorithm, but I don't like the strategy that goes with it. None of that fits me. But I do like the idea of an algorithm. And then you might go over and say, hey, I like what Ross is doing with momentum, but none of that else fits me. And so you might bounce around and find all these pieces. And then you go and you create your own deal. You make your own algorithm, you make your own strategy, your own trading plan, and you do your own thing based on what you see other people doing. So it can help to look at what everybody else is doing as well and make something that fits you. Take what's best of what all of them are doing that fits you perfectly. So don't feel like you have to follow somebody else or trade their thing. If it doesn't fit you, it's not going to work. You're going to lose all your money. So be patient. Don't be afraid to create your own thing. I do not want you purchasing my algorithm to trade my strategies if they don't fit you. So, and you shouldn't do that with anybody else either. All right, next. All right, so trading you or trading them. So your personality, lifestyle, and goals. So real quick. So personality, we kind of touched on. Are you someone can react quickly? If you can't react quickly, maybe you have to look at what time frame you're trading on. Maybe a 1 minute candle is too fast for you. If you get bored, maybe a 10-minute candle is too slow for you and so forth, right? So personality, understand what that is. If you feel like you're stressed out and shaking when you're trading and you just can't handle it, it's probably because you're in with too much size. So, your scaling ladder has to fit your personality. Some people can't take that much risk because they're freaking out. And then that's going to make you do emotional things and make bad decisions. And that's going to allow the market to win. It's going to allow the market to manipulate you out of your trading plan and win. If you're going to stick to your plan, maybe you have too much size. You need to revamp your plan a little bit to have a slower scale up. Start with smaller size. So lifestyle, what is your lifestyle? Do you want to trade all day and spend 8 hours a day in an office? Or are you trying to get away from that? You want to spend 5 minutes a day and then the rest of the time you're out on the boat. So what's your lifestyle? And make sure your trading plan fits that lifestyle. Don't sacrifice. Because if you do, trading is not going to be fulfilling for you. And then you're going to start missing out on stuff. For example, right now, like my lifestyle doesn't really fit my trading plan. But I stick with it because this is what I'm teaching. But with my social media account anyway. My family account, it's perfectly fine. So, and that is, I'm traveling a lot right now and I don't have a lot of time to trade. So I don't want to have a strategy that requires me to trade every opportunity of every day because I know I'm not going to be able to do that. And if I can't do that, and that's what the strategy requires, I know I'm going to lose my money. So with my social media account, it is like that. So it's a little bit sensitive. I got to be really careful with that account. But with my family account, my strategy right there is set up to where I can just trade a couple times a week. And it gives me all the time I need to do all the stuff I need. But the size of trading is pretty large so that from a personality standpoint, I have to be okay with, those kind of numbers on losses and wins, and they're pretty big. So, you got to find a balance there. And then goals. How much money do you want to make this year? How do you want to progress in your trading? You have to be very realistic with yourself. Set those goals. Make a plan that fits those goals. Maybe I have a job that makes me $50,000 a year, and I'd like to just replace my income. So maybe my goal this year for trading is $50,000. So now what is my trading plan? I need to be able to make 50 grand by the end of the year. That's the goal anyway, not a requirement, just a goal. And how can I get there? And then you make a plan around that. So, and now if my plan only allows me to trade 5 times a year, but then I need to buy so much size that I can't make enough. So you start to figure out all these things when you start asking yourself these questions, and it all boils down to a trading plan. And maybe what everybody else is doing on the market that you're looking at, including me right now, might not fit you. So once you've answered the question of what's your personality, your lifestyle, and your goals, and you need to find something that fits you if you're going to be successful. Trading what somebody else is trading will probably cause you to fail if it doesn't fit you. And that's episode 1 of Why Traders Fail. And I know it's long. I try to make it short. I only covered a couple little things. That's why there's going to be lots of episodes coming out, because there's so much information on why you could fail in the market. But it goes back to the very first fundamental simple thing. What is the game? What do you need to play the game? How do you win and how do you lose, right? You need your trading plan and your trading log to play. You win when you can stick to your plan. You lose when the market knocks you off your plan. That's simple. That is the market. So traders, get your pen and paper out there. Start to assess yourself. Assess what you're doing. Even if you're a pro trader, can you make more money if you have a better trading plan based on some of the things we've already talked about? All right, everybody. We'll see you on the next one. And if you like the information I provided you in this lesson, episode 1, please hit that like button at the bottom. That would help me out a lot. If you disagree with something, or you have questions, or you're not sure, or you have other ideas, put it in the comments below. And again, let's keep it constructive. Let's help each other. The way I see it is every challenge is an opportunity for you to learn or for you to educate. So please go ahead and put stuff down there. Let's help each other out in the community. And if you want more information on my strategy and my algo, pop over to my website. I do not spam you. If you sign up as a student over there, you get an email once a week from me giving you updates. And that's it. Maybe once a month even. I do not spam you every day. I hate that, so I won't do that to you. I don't sit there begging you to buy my algorithms or any of my stuff like that. I only want you to do what's right for you, and you need to make those decisions on your own. So check it out. Link below. Get my log, get my algo if you want, or just get my education. All right, everybody. Have an awesome day.